Are you tired of feeling trapped by high interest rates on your mortgage or loan? What if I told you there are simple strategies you can use to save thousands, even tens of thousands of dollars over the life of your loan? In this video, I'll share insider tips and proven techniques to help you lower your interest rates, reduce your monthly payments, and take control of your finances. Whether you're buying your first home or refinancing an existing loan, these steps could change the way you think about borrowing forever. Stay tuned, because the savings start right now. 1. Negotiate with the bank or lender. Negotiating with your bank or lender is one of the most effective ways to secure a lower interest rate and reduce the overall cost of your loan. To begin, it's essential to research the market thoroughly. Familiarize yourself with current interest rates by consulting reliable sources such as Bankrate, Zillow, and Freddie Mac, which provide daily updates on average rates for loans with varying terms like 15-, 20-, and 30-year fixed mortgages. Understanding these benchmarks gives you a clear picture of what is considered competitive in the market. Additionally, monitor announcements from the Federal Reserve, as its decisions significantly influence interest rates. For example, if the Fed cuts rates, lenders might be more willing to lower your rate as well. This knowledge serves as a powerful tool during negotiations, showing lenders that you're informed and prepared. Your credit history plays a pivotal role in how favorably lenders view your request for better terms. Before initiating negotiations, obtain a copy of your credit report from annualcreditreport.com, a free service for U.S. residents, and review your credit score through platforms like Experian, Equifax, or TransUnion. A high credit score, typically 700 or above, signals financial responsibility and reduces the risk you pose to lenders. If your score is lower than expected, take proactive steps to improve it, such as paying down outstanding balances, correcting errors on your report, or avoiding new debt. Once your credit score is in good standing, leverage it during your discussions. Highlight your consistent payment history, low debt-to-income ratio, and financial stability to demonstrate why you qualify for a lower rate. Using competing offers as leverage is another powerful strategy. Approach multiple financial institutions, including credit unions, online mortgage companies, and national banks, to request loan quotes. Many lenders provide pre-approval letters that outline the interest rates and terms they can offer. These documents are valuable bargaining tools, as they create competition. Present the best quotes to your current lender and express your preference to stay with them if they can match or beat the terms. If your lender values your long-standing relationship or fears losing your business to a competitor, they are more likely to accommodate your request. However, be prepared to walk away if they don't offer better terms. This demonstrates that you are serious about finding the best deal. In addition to negotiating the interest rate, focus on reducing or waiving closing costs and additional fees. These costs, which may include origination fees, appraisal fees, underwriting charges, and administrative expenses, can significantly impact your loan's total cost. Start by reviewing the loan estimate document provided by your lender, which itemizes these fees. Then, question the necessity of each charge. For instance, if you're a repeat customer with strong credit, the lender might agree to reduce or eliminate origination fees. Similarly, if you recently had your home appraised, they may accept the existing report rather than requiring a new one. Ask about the possibility of waiving administrative or processing fees, as these are often discretionary. Finally, consider discussing options for purchasing discount points. Paying points up front allows you to reduce your interest rate over the life of the loan. For example, 1.1% of the loan amount might lower your rate by 0.25%. However, this strategy is only beneficial if you plan to stay in the home long enough to recoup the upfront cost through monthly savings. Carefully calculate the break-even point to ensure it aligns with your long-term plans. Negotiating with your lender requires preparation, confidence, and persistence. By arming yourself with market knowledge, leveraging your creditworthiness, utilizing competing offers, and addressing fees, you can significantly improve your loan terms and save money. Even small concessions in rates or costs can translate into substantial long-term savings, making this effort well worth your time. 2. Increase the down payment. Increasing the down payment is a highly effective strategy to reduce the overall cost of your loan, as it lowers the amount financed and can significantly improve the interest rate offered by lenders. The larger the down payment you make, the less risk the lender assumes, which often results in more favorable terms. Here's how this strategy works and why it can save you substantial amounts over the life of your loan. When you make a larger down payment, the first and most immediate benefit is that it lowers the principal balance, the amount you're borrowing. Since interest is calculated based on the principal, reducing this amount directly decreases the total interest you'll pay over the life of the loan. For instance, consider purchasing a $300,000 home. If you put down 20%, $60,000, you'll only need to finance $240,000. In contrast, with a 10% down payment, $30,000, you would need to finance $270,000, which not only increases your monthly payments but also the total interest costs over time. The larger your down payment, the more you save in interest payments, making this an effective long-term strategy. Another key advantage of a larger down payment is avoiding private mortgage insurance, PMI. In the U.S., most lenders require borrowers who put down less than 20% to purchase PMI, which is designed to protect the lender if the borrower defaults on the loan. PMI typically costs between 0.5% and 1% of the loan amount annually. For a $300,000 loan, this could mean an extra $1,500 to $3,000 per year in insurance costs. Over several years, this adds up to thousands of dollars. By making a 20% down payment upfront, you eliminate the need for PMI entirely, which significantly reduces your monthly payments and the overall cost of the loan. If you're already paying PMI, one potential strategy is to pay down your loan principal until you reach at least 20% equity in your home, at which point you can request the removal of PMI. This step can provide substantial savings even after your loan is in place. To save for a larger down payment, it's essential to develop a structured savings plan. Start by assessing your monthly budget and identifying areas where you can cut back to allocate more toward your down payment fund. High-yield savings accounts or money market accounts can help grow your savings faster while keeping them secure and accessible. If you're a first-time homebuyer, you may also have the option to tap into certain retirement accounts, such as IRAs, to help fund your down payment. For example, the IRS allows first-time homebuyers to withdraw up to $10,000 from an IRA without incurring an early withdrawal penalty, although taxes may still apply. However, this decision should be made carefully, as it could impact your long-term retirement goals. Consulting a financial advisor can help ensure this approach aligns with your broader financial plan. Another potential source for increasing your down payment is family gift contributions. Many lenders permit a portion of the down payment to come from gifts, as long as the money is properly documented as a gift rather than a loan. This requires a formal gift letter, which typically includes the donor's name, relationship to the borrower, and a statement confirming that the funds are a gift with no expectation of repayment. If family members are willing to assist, this can be a great way to increase your down payment without depleting your own savings. However, each lender has specific guidelines regarding gift funds, so it's crucial to check their requirements and ensure you have the necessary paperwork ready to meet their criteria. 3. Refinance the loan. Refinancing your loan can be a strategic move to take advantage of improved market conditions or to better align your mortgage with your financial goals. The process involves replacing your existing loan with a new one, potentially securing a lower interest rate, adjusting the loan term, or even accessing cash for other needs. To make the most of refinancing, It's important to understand the different types, costs, and potential benefits involved. First, choosing the right type of refinancing is critical. The two most common options are rate and term refinancing and cash-out refinancing. Rate and term refinancing focuses on reducing your interest rate, changing your loan term, or both. This option is ideal if your primary goal is to lower monthly payments, save on total interest, or pay off your mortgage sooner. On the other hand, cash-out refinancing allows you to borrow more than your current loan balance and take the difference as cash. This option can be useful if you need funds for home improvements, debt consolidation, or other financial needs. However, cash-out refinancing increases your loan balance and may come with a slightly higher interest rate than rate and term refinancing. Carefully evaluate which option aligns with your short and long-term financial objectives. Understanding the costs associated with refinancing is essential to determine if it's the right move for you. Refinancing comes with closing costs that typically range from 2% to 5% of the loan amount. These costs include appraisal fees, origination fees, title insurance, and other administrative expenses. To assess whether refinancing is worthwhile, calculate the break-even point, which is the time it takes for your monthly savings from a lower interest rate to cover the upfront refinancing costs. For example, if refinancing costs $5,000 and reduces your monthly payments by $200, the break-even point is 25 months, $5,000 divided by $200. If you plan to stay in the home for at least that long, refinancing could be a smart financial decision. Conversely, if you anticipate moving or selling the property before reaching the break-even point, it may not be cost-effective. Another advantage of refinancing is the option to switch to a shorter loan term, such as moving from a 30-year mortgage to a 15-year mortgage. Shorter-term loans often come with lower interest rates, which can save you tens of thousands of dollars in interest over the life of the loan. While your monthly payments will be higher, you'll build equity faster and pay off your home sooner. Refinancing calculators can help you determine whether your budget can accommodate the increased payments and quantify the potential savings. For homeowners who are financially stable and want to reduce their long-term debt, refinancing to a shorter term can be a game changer. It's also important to consider the tax implications of refinancing. In the U.S., mortgage interest is generally tax-deductible, which can lower your taxable income. However, if you refinance to a shorter term or significantly reduce your loan balance, your total interest payments will decrease, which could result in a smaller tax deduction. While this reduction in deductions isn't necessarily a negative, since you're saving on interest overall, it's worth consulting a tax advisor to fully understand how refinancing might impact your tax situation, especially if you rely on mortgage interest deductions as part of your financial planning. Ultimately, refinancing offers numerous benefits, from lowering your interest rate and monthly payments to building equity faster and accessing cash for other needs. However, it's not a decision to take lightly, as the associated costs and implications can vary depending on your situation. By carefully evaluating your options, understanding the financial trade-offs, and aligning the refinance with your goals, you can ensure that this strategy works in your favor. 4. Opt for a shorter loan term. Opting for a shorter loan term is a powerful strategy for homeowners looking to save money on interest and accelerate their path to financial freedom. By choosing a loan term of 15 or 20 years instead of the traditional 30 years, you can benefit from lower interest rates, faster equity accumulation, and the ability to align your mortgage payoff with key financial goals, such as retirement. However, this decision requires careful consideration of your budget and long-term financial strategy to ensure it aligns with your overall objectives. One of the most compelling reasons to choose a shorter loan term is the lower interest rates typically offered by lenders. Shorter-term loans are less risky for lenders because the repayment period is shorter, reducing the chances of default over time. As a result, Lenders often provide significantly lower interest rates for 15-year or 20-year loans compared to 30-year options. This rate difference can lead to substantial savings over the life of the loan. For example, if a 30-year mortgage has a 6% interest rate and a comparable 15-year mortgage offers a 5% rate, the shorter-term loan not only reduces the total interest you pay but also allows you to pay off your home in half the time. The cumulative savings in interest can amount to tens of thousands of dollars, making this option highly attractive for those who can afford the higher monthly payments. Another advantage of a shorter loan term is the ability to build home equity faster. Equity is the portion of your home's value that you own outright, and it increases as you pay down the principal on your loan. With a shorter-term mortgage, a larger percentage of each monthly payment is allocated to the principal balance rather than interest. For instance, in the early years of a 30-year loan, the majority of your payment goes toward interest, leaving your principal largely untouched. In contrast, a 15-year loan significantly accelerates principal repayment, helping you build equity at a much faster pace. This increased equity can be an important financial asset, providing you with more flexibility for future needs, such as funding home improvements, consolidating debt, or accessing cash through a home equity loan or line of credit. While the benefits of shorter loan terms are clear, it's essential to carefully plan your budget to accommodate the higher monthly payments that come with them. Because the repayment period is condensed, your monthly payments will be higher than those for a 30-year loan, even with the lower interest rate. For example, a $300,000 loan at a 6% interest rate over 30 years might result in monthly payments of $1,800, while the same loan at a 5% interest rate over 15 years could require payments of $2,400. The difference in payments can be significant, so it's crucial to assess whether your current income and financial obligations can support this increase. Online mortgage calculators can be incredibly helpful in modeling different scenarios, allowing you to compare the monthly payments, total interest paid, and overall cost of loans with varying terms. Make sure to account for other financial priorities, such as retirement contributions, emergency savings, and day-to-day expenses, to ensure that committing to a shorter loan term doesn't strain your budget. For homeowners planning for retirement, a shorter loan term can offer significant long-term benefits. Entering retirement without the burden of a mortgage can dramatically reduce financial stress and free up resources for other needs, such as healthcare, travel, or supporting family members. By aligning your mortgage payoff with your retirement timeline, you can achieve the peace of mind that comes with owning your home outright. For instance, if you're in your 40s or 50s and opt for a 15-year mortgage, you could eliminate your mortgage payments well before retirement, allowing you to redirect those funds into retirement savings or other investments. This strategic alignment of loan terms with retirement goals can help ensure financial stability in your later years, making a shorter loan term a wise choice for those with the means to manage higher payments now. 5. Make extra payments toward principal. Making extra payments toward the principal of your mortgage is a highly effective strategy to reduce the total interest you pay and shorten the loan term, ultimately saving you money and helping you achieve financial freedom sooner. This approach works by directly decreasing the outstanding loan balance, which is the foundation for calculating interest. By reducing this balance faster than scheduled, you lower the amount on which interest accrues, leading to substantial long-term savings. Here's a detailed breakdown of how to maximize the strategy and its benefits. When making extra payments, it's essential to direct those payments specifically toward the principal rather than the interest or future payments. Many lenders allow borrowers to make additional payments without prepayment penalties, but it's crucial to verify this with your lender. When submitting an extra payment, include clear instructions that the additional amount is intended for the principal. Some lenders may automatically apply extra funds toward the next scheduled payment instead of reducing the principal unless specified. By ensuring the payment goes directly to the principal, you decrease the overall loan balance, which reduces the total interest that accrues over time. Even small extra payments can have a meaningful impact, especially if done consistently. One popular and manageable method of making extra payments is to switch to biweekly payments instead of the traditional monthly schedule. With this approach, you divide your monthly mortgage payment in half and pay that amount every 2 weeks. Because there are 52 weeks in a year, this results in 26 half payments, or the equivalent of 13 full monthly payments annually. This extra payment is applied to the principal, effectively accelerating your repayment schedule. For example, on a 30-year mortgage, this strategy can shave off several years from the loan term and save tens of thousands of dollars in interest, all without requiring a large upfront commitment. Biweekly payments also align well with biweekly paychecks, making them easier to budget for than lump sum contributions. Timing plays a critical role in maximizing the impact of extra payments, particularly during the early years of the mortgage. Mortgage payments are typically structured with an amortization schedule, where a larger portion of your payment goes toward interest at the beginning of the loan term, and more is applied to the principal in later years. Because the interest is calculated on the outstanding loan balance, reducing the principal early on has a disproportionately larger effect on lowering total interest paid. For instance, an extra $1,000 applied to the principal in the first year of a 30-year loan will save significantly more in interest than the same payment made in year 20. By prioritizing extra payments in the early stages of your mortgage, you can maximize your savings and shorten the overall loan term more effectively. Another simple yet impactful way to make extra payments is to use windfalls, such as bonuses, tax refunds, or monetary gifts. These lump sum payments, while often unplanned, can provide an excellent opportunity to reduce your mortgage balance without affecting your regular budget. For example, applying a $5,000 year-end bonus or tax refund directly to the principal could shorten your loan term by several months or even years, depending on your loan amount and interest rate. Unlike regular income, which may already be allocated toward monthly expenses, windfalls can serve as a convenient and impactful tool to accelerate mortgage repayment. To implement this strategy effectively, consider setting a goal for how much extra you want to pay each year and create a plan to meet it. For instance, you might aim to apply an additional $200 per month toward your principal, totaling $2,400 annually, or commit to applying any annual tax refund in full. Using online mortgage calculators, you can model the impact of these extra payments on your loan term and total interest savings, which can serve as motivation to stick to your plan. 6. Pay attention to the annual percentage rate (APR). Paying attention to the annual percentage rate (APR) is crucial when evaluating mortgage options, as it provides a comprehensive view of the loan's total cost beyond just the interest rate. While the interest rate reflects the cost of borrowing the principal amount, the APR accounts for additional fees and expenses, offering a more accurate picture of what you'll pay over the life of the loan. By understanding the nuances of APR, you can make more informed decisions, avoid unnecessary costs, and potentially save thousands of dollars. One of the most important reasons to focus on the APR is its usefulness for comparing loans. Two loans with identical interest rates can have vastly different APRs because of varying fees and costs, such as origination fees, appraisal charges, and private mortgage insurance, PMI. For example, one lender might advertise a 5% interest rate, but with high fees that bring the APR to 5.8%, while another lender offers a 5.2% APR on the same interest rate with fewer additional costs. When comparing loans, prioritize the APR over the advertised interest rate, as it provides a more realistic measure of the loan's total cost. This can help you identify hidden expenses that might otherwise go unnoticed. A critical step in evaluating APR is to scrutinize the list of fees and charges included in the calculation. The APR typically incorporates lender-specific fees, third-party charges, and optional costs. These can include origination fees, the cost of processing the loan, application fees, underwriting fees, title insurance, and prepaid interest. While some of these charges are standard, others may be inflated or unnecessary. For instance, administrative fees or processing charges are often negotiable, and lenders may be willing to lower or waive them entirely to secure your business. Ask for a detailed breakdown of the APR, and don't hesitate to challenge or negotiate fees that seem excessive or redundant. Another way to minimize costs and keep the APR manageable is to avoid unnecessary add-ons that lenders may bundle into your loan package. These can include optional products such as disaster insurance, extended warranties, or loan guarantees. While some of these add-ons might seem appealing or provide peace of mind, they can significantly inflate the APR and may not be essential. For example, disaster insurance might already be covered by your homeowner's insurance policy, making the additional coverage redundant. Take the time to evaluate each product carefully, and only agree to those that are genuinely necessary and align with your specific needs. Declining optional add-ons can result in significant savings over the life of the loan. When analyzing the APR, it's also important to understand how it relates to the loan term. Shorter-term loans often have lower APRs, even if their interest rates are slightly higher, because the total amount of fees is spread over a shorter repayment period. Conversely, for longer-term loans, the APR may be higher due to the accumulation of interest and fees over time. Keep this in mind when evaluating loans with different terms and structures, as a lower APR on a shorter-term loan could result in substantial long-term savings, even if the monthly payments are higher. Now that you've learned these powerful strategies to lower your interest rates and save money on your financing, it's time to take action. Remember, even small adjustments can lead to significant savings over time. Whether it's negotiating with your lender, increasing your down payment, or making extra payments, every step brings you closer to financial freedom. If you found this video helpful, don't forget to like, subscribe, and share it with someone who might benefit from these tips. Let me know in the comments which strategy you're excited to try, or if you have questions. I'd love to hear from you. Thanks for watching, and here's to smarter, more empowered financial decisions.